Welcome everybody to our module 2. I'll be opening up Q&A at the end. Short the Chinese offshore yuan CNH for an opportunity of a lifetime. Here's the big picture. The Chinese have printed 210 trillion yuan in the form of credit or money in the past 30 years. And at this juncture in time, they value those 210 trillion yuan at 30 trillion US dollars. And they back this claim up to a great degree from the value of real estate they've built, which has never been fairly valued in a free market. It's a huge Ponzi scheme with price controls forcing prices up, and there's absolutely no price discovery. In fact, you're not even allowed to sell for a lower price than you purchased, which has forced their housing market to go up from day one. And now they've abandoned countless cities known as ghost cities, and even tier 1 cities aren't at full capacity. This brings 210 trillion yuan that are desperately wanting to convert out of CNH into the dollar, the euro, the yen, anything else, gold, crypto, real estate. But the Chinese government has extremely strict capital controls. Money can come in, but it's not allowed to flow out. Their currency is thinly traded and not even available to trade at most broker dealers in the futures market. China needs jobs for a huge population of 300 plus million prime age workers and wants to build the Belt and Road Initiative next. To do this, they really need the yuan to be a reserve currency so that they can convert their, quote, $30 trillion worth of yuan into money that can actually be spent to pay for the project. The more of their yuan they want to spend, the more they'll have to allow for a fair price in an open foreign exchange market. And in order for China to attract investors, they'll want to be able to easily buy and sell the currency in a free market. Throw into the pot Trump, tariffs, and probably a multi-decade feud for world supremacy, and we've got a full-blown currency war underway. My bet is that 7 yuan is worth far less than $1 US, and over time, China will have to allow the yuan to devalue to attract capital. And right now, their currency is easily manipulated and thinly traded, but they've been losing control since 2010, when their GDP began crashing. I'll show you just how much money we can make from this trade, not just in the immediate future, if trade war escalates, but long term for the next 5 to 10 years, and it's a ton. First, let's look at some charts and some ghost cities so you can get a bigger picture of what's really going on. China has enjoyed 8% growth from building huge cities primarily for the past 30 years. But you can see this growth trend has died since 2010 and has been on a steady decline. They've built some very impressive cities, which they call tier 1 cities and tier 2 cities. And they're remarkable. Probably some of the most beautiful cities in the world. Although even their tier 1 cities are not at full capacity. Many of these skyscrapers are only partially rented. And many of the cities have proven to be highly unprofitable ventures in total, as their debt continues to grow at a much faster rate than their GDP. And now they're near 300% debt to GDP. So the result is that they've abandoned many of these cities. They realize they've over-constructed, And city after city has been left abandoned for the time being, as they now direct all their attention at this Belt and Road Initiative. And this is while 30 million Chinese still live in caves with no irrigation, plumbing, and over 50 million residential houses have been built and abandoned and never sold, because once again, they're not allowed to sell for a loss. Every price must reach a new profit to keep this Ponzi scheme alive. And so you can see these empty cities where people are riding around on their bikes in massive 8-lane highways. Huge residential condos built, but no one lives in them. It's a $1 trillion nightmare for China that they'll be dealing with most likely for the next decade. A misallocation of capital that's never been seen in history. It's as if time had frozen still in China in terms of their construction. And now this is by far the biggest real estate bubble ever. In fact, when the US had its bubble, it was only about 2% of GDP. They're estimating the Chinese GDP for housing sector alone is over 4%. And when you look at the big picture, it may be closer to 25% of their total GDP. It's the 2008 housing bubble all over again, but at a $13 trillion GDP per year scale. And to keep this bubble going, Chinese urban home purchases are having to purchase 2 and now 3 homes. At the same time, Chinese household debt compared with income becomes tighter and tighter. Income is growing much slower than their household debt, going from 18% ratio in 2006 to a 77% in 2017. And they are now forced to deleverage, as they have had to do several times in the past 3 decades, which involves allowing bad investments to fail or be absorbed by profitable ventures. And they're on track to drop well below 6% GDP in the coming years. Periods of major deleveraging include 1990 through 1995, where we saw the yuan devalue from 4 to as high as 9. 2004 through 2008, where we actually saw their currency strengthen slightly. And then from 2010, since their GDP has crushed below 10% and is now falling below 6%, we've seen they've once again lost control. And just a year ago, their whole strategy was to keep the conversion rate between 6 and 7. But we've burst beyond 7 during this trade war several times now. Here's a zoomed in look at China's debt to GDP. And what I want to point out here is that since 2017, they've stopped growing the debt because they're realizing this strategy is not effective. They're growing debt at a faster rate than they're growing growth. We've also seen a remarkable correlation between how much money they've printed and what their GDP has been. And this is in a marketplace where they control prices. They create mandates for different zones of the country to hit GDP goals. So in the last 25 years, they've grown their money supply by 2,900%, or a compounded rate of 14.5%. In the last 10 years, it's grown by 230%, or at a 13% compounded rate. In the past 5 years, they've grown the money supply by 66%, or a 10.7% compounded growth rate, down from 13%. And in the past year, their growth of money has shrank to 7.5%, similar to the shrinkage in their GDP. And the problem is simple. They have created far too much debt relative to growth. The strategy did not work. And now worry grows about China's falling currency and rising dollar-denominated debt. They have over $1 trillion in dollar-denominated debt. That forces them to convert the yuan into dollars just to pay the interest on these debts. And it's not just China that has debts denominated in dollars, it's the entire world. There's a world record of USD denominated debt issued by non-banks outside of the US to the tune of $11 trillion. This forces every country that's made these loans denominated in dollars to consistently convert their currency into dollars to pay the interest. And so what we have is a lack of demand for Chinese currencies, and really for almost every foreign currency, and a huge demand for the dollar because all of the debts are denominated in dollars. Here's a look at credit to selected non-bank borrowers. So these are just retail loans that have been denominated in dollars. And we can see $1 trillion in China, 120 billion in Korea, 40 billion in Malaysia, 120 billion in India, 160 in Indonesia, and 50 in the Philippines. And if you look at this chart, we can see which countries have a reserve as a percentage of USD debt against its external debts. And there are certain countries that are at high risk, like Chile, Argentina, Turkey, Mexico, Indonesia. But as we go through each of these currencies, you'll see they all have the same problem. They've been rapidly losing value against the dollar. Here's your Chilean peso, losing half of its value since 2012, making debt twice as expensive to service. The Argentine peso has gone into hyperinflation mode, making their debts totally unsustainable in dollar-denominated terms. The Turkish lira has devalued from 2 to almost 6 just in the last 5 years, making their debts 200% more expensive to pay the interest on. The Mexican peso has lost approximately 60% of its value just in the last several years. The African rand, once again, has lost half of its value just in the last 5 years, making its debts twice as expensive to pay the interest in US dollars. The Brazilian currency has lost 250% of its value since 2011 and 400% since 1996. One of the few currencies to actually stabilize is the Russian ruble, but they have very high interest rates on money and extremely low debt. So this has come at the cost of low growth. And even in India, despite their massive growth and high levels of GDP, their currency has also nearly lost half of its value against the dollar since 2008. Here's a look at the money supply in China against its foreign exchange reserves. You can see they were happy to print away trillions of their own currency, but they've failed to grow their foreign exchange reserve. And so now we have a lot of money trapped in the yuan that desperately wants to convert into a better, more stable currency. And despite China doing everything it can to block all capital outflows, billions and billions of dollars are flowing out of China in every crack that they can find. The Great Wall of Finance Control. China lets money in, but they do not let money out. It's a trap. And so you can see they use the Hong Kong exchange, the Shanghai exchange to bring money in, but good luck getting it out. China's authorities have capped overseas withdrawals using Chinese banks to 100,000 renminbi. And the yuan is just the unit of the renminbi, or about $15,000 a year that you can convert. They've created many capital controls. You cannot make any type of large purchase outside of China without approval from the government. And so now China is at a huge risk to what happened in the 1997 Asian financial crisis. This is where many currencies went into hyperinflation mode when the US central bank began hiking interest rates on the federal funds rate. The government must approve foreign acquisitions valued over 10 billion. Foreign acquisitions above 1 billion if they're outside of the acquirer's core business. And so now you can start to understand why on earth the United States is able to create so much debt and easily sell it around the world. All of these countries have massive debts that they must pay the interest in dollars. So it makes sense to pick up a treasury and get a little bit of free money from the yield. The euro, when I was a kid, I remember thinking everything was expensive in London because their currency was worth more than ours. Won't be that way for much longer. It's now devalued down to 1.1 against the dollar. The only currency that has held its weight decently is the Japanese yen. But to do so, the country has gone into massive debts. They have the highest public debt in the world. And this will eat away at the savings of retirees and create a massive burden on new generations being born in Japan. And even though the US is the biggest debtor in the world, as a percentage of GDP, we're healthier than all of our core competitors like Germany, Italy, France, United Kingdom, Brazil, Spain, or Canada. Now you see China has low public debt. That's because they've just borrowed the money from themselves, from their central bank. And the reason they've done that is because of their legal structure. No one wants to invest in China. They know they'll never get their money back. There's no rule of law. In terms of external debts, once again, the US is still in a healthier position than almost all of its competitors. The only two outliers are Japan and China, but again, those countries have created extreme internal debt by devaluing their currencies. Now, the trade war and tariffs provide additional pressure for the yuan to devalue in the near future. But this is a big play that can last for years. China has already shown that they will devalue to offset tariffs despite it tarnishing its currency's reputation as a stable store of value and causing more outflow pressure. To profit from this trade opportunity requires a good understanding of the tariffs and how it's impacted exchange rates. Let's take a look at what the US and China has done during the trade war to date and how it's impacted the USD-CNH exchange rate. I'm not going to read every little piece of the trade war because it's very lengthy, but I'll pick out the highlights. In May of 2016, Trump was campaigning at this point and said we cannot allow China to rape our country, and that's what they're doing. It's the greatest theft in the history of the world. September 21st, China is neither an ally or a friend. They want to beat us in our own country. And we can see just with this threat, the currency immediately began to devalue with a move of 0.6, going from 6.4 to 7. April 6th through the 7th, 2017, President Xi visits Trump's Mar-a-Lago estate in Florida, where they agreed to a 100-day action plan to resolve trade differences. During this period, the currency strengthened 0.3. May 22nd, U.S. and China agreed to a trade deal that would give U.S. firms greater access to Chinese agricultural, energy, and financial markets, while China gains access to sell cooked poultry to the U.S. August 18th, USTR initiates an investigation into certain acts, policies, and practices of the Chinese government relating to tech transfer. November 8th through 10th, Trump pays a state visit to China, where relations were considered to have warmed. During this period, the currency strengthened for nearly a year, tightening by 0.7 over 11 months. March 22nd, 2018, Trump signs a memorandum directing the following acts: WTO case against China for discriminatory licensing, restrict investments in key technology sectors, impose tariffs on Chinese products. March 23rd, U.S. imposes a 25% tariff on all steel imports and a 10% tariff on aluminum imports. April 2nd, China imposes tariffs on 128 U.S. products. April 3rd, USTR releases an initial list of 1,334 proposed products, $50 billion worth of imports for a 25% tariff. April 4th, 2018, China reacts, proposes 25% tariffs to be applied on 106 U.S. products. Also $50 billion in U.S. goods such as soybeans, hitting the farmers. April 16th, U.S. Department concludes that Chinese telecom company ZTE violates U.S. sanctions. U.S. companies are banned from doing business with ZTE for 7 years. April 17th, China announces anti-dumping duties of 178% on imports of sorghum from the U.S., once again targeting the farmers. May 3rd through 7th, U.S.-China engage in trade talks in Beijing, where the U.S. demands that China reduce the trade gap by $200 billion within 2 years. Talks end with no resolution. Trump promises to help ZTE in a tweet. May 13th, China's Commerce Ministry announces it will stop tariffs on U.S. sorghum at negotiations. May 29th, U.S. reinstates tariff plan after brief truce. May 20th, U.S. and China agree to put trade war on hold after China reportedly agrees to buy more U.S. goods. June 4th, 2 days of trade talks between U.S. and China held in Beijing. June 7th, U.S. and ZTE agreed to a deal that will allow ZTE to resume business. June 15th, initial list of products reduced and finalized. 25% tariff on 808 products, lowered from 1,334, set to take effect on July 6th. June 16th, China revises its initial tariff list, 25% on 106 products, now to include 25% tariff on 504 products. July 6, 2018, U.S. implements first China-specific tariff U.S., representing $34 billion in goods. July 10th, U.S. releases second tariff list. USTR releases a third list of tariffs over 6,000 commodities originating in China, worth $200 billion, subject to a 10% tariff. August 2nd, U.S. tariffs are revised. August 3rd, China announces second round of tariffs on U.S. products in response to the $200 billion worth of products. China's Ministry of Commerce proposes a range of additional tariffs on 5,207 products originating from the U.S., worth $60 billion. August 7th, second round of tariffs finalized and released. August 14th, China files WTO claim against the US. August 22nd through the 23rd, US-China dialogue. Meet for the first time since early in the trade war. US Treasury Secretary and Chinese Commerce Vice Minister met in Washington, D.C. No major breakthroughs. US and China implement second round of tariffs, and China files second WTO complaint. China implements retaliatory 25% tariffs on 333 goods worth $16 billion, including commodities such as coal, copper, fuel, medical equipment. September 7th, Trump threatens new tariffs. Trump threatens to impose tariffs on $267 billion more. That would bring the total amount of tariffs threatened or imposed by US to $517 billion, accounting for essentially all Chinese exports in the US. September 12th, US invites China to reopen negotiations. The White House top economic advisor, Larry Kudlow, says that the US has invited China to restart trade negotiations before tariffs on $200 billion worth of goods goes into effect. September 17th, US finalizes tariffs with an effective date of September 24th. September 18th, China announces retaliation for US tariffs on $60 billion worth of US goods. September 22nd, China cancels trade talks with US. September 24th, US and China implement third round of tariffs. October 25th, US and China officials resume contact. The officials are reportedly preparing for Trump and Xi to meet on the sidelines of the November G20 meetings in Argentina. October 30th, US reportedly prepared to announce tariffs on remaining Chinese products. November 9th, 2018, US and China resume trade talks. During this period, we had a 0.7 move that lasted 8 months. Much of this was realized in June, but the move did continue strong for July, August, September, and October, traveling from 6.3 to 6.9. November 19th, 2018, US releases list of proposed export controls on emerging technologies. December 2nd, 2018, US and China agreed to temporary truce. Following a working dinner at G20 summit in Buenos Aires, December 1st, US and China refrained from increasing tariffs or imposing new tariffs for 90 days until March 1st, as the two sides work towards a larger trade deal. US agrees to delay tariffs, and China will purchase more US products, especially agricultural products, and will crack down on the production of fentanyl. December 4th, 2018, China to temporarily lower tariffs on US autos and resume buying soybeans. January 9th, US and China engage in 3-day trade talks in Beijing. The first face-to-face meeting since agreeing to a 90-day truce, which would end March 1st. January 22nd, US cancels preparatory talks with China. January 30th, US and China hold 2-day trade talks in DC. February 7th, Trump says he will not meet with Xi before a trade deal deadline. US and China hold trade talks in Beijing. February 15th. February 24th, US and China hold trade talks in Washington. Trump extends the tariff deadline. March 29th, US and China hold trade talks in Beijing after 1-month break. March 31st, China extends the suspension of additional tariffs on US auto parts. April 1st, China bans all types of fentanyl, supposedly a win for US in the fight against drugs. April 5th, US and China hold trade talks in Washington. April 10th, 2019, US and China agreed to establish trade deal enforcement offices. During this period, the currency only strengthened 0.3. April 30th, US and China hold trade talks in Beijing. May 5th, Trump threatens to raise tariffs on China. Trump says he would come up with new tariffs of 25% on an additional $325 billion worth of Chinese goods, which would essentially cover all remaining Chinese products. This is due to go live December 15th as we speak. May 10th, US increases tariff from 10% to 25% on 200 billion of goods. May 13th, China announces tariff hikes on US products and China launches tariff exemption system. China increases tariffs on 60 billion in goods. Products affected include beef, lamb, pork, vegetables, cooking oil, targeting the farmers. May 16th, US places Huawei on its entity list, banning it from purchasing from US companies. May 31st, China establishes its very own unreliable entities list. June 1st, China increases tariffs on 60 billion worth of US goods. Separately, China announces that it has opened an official investigation into US shipping company FedEx for diverting packages from Japan. June 2nd, 2019, China issues white paper on US-China economic relations. The white paper denounces US's unilateral and protectionist measures, criticizing the backtracking of Sino-US trade talks, and demonstrates China's stance on trade consultations and the pursuit of reasonable solutions. June 18th, Xi and Trump rekindled trade talks ahead of G20 meeting. June 19th, US tariff exemption process for Chinese imports. June 21st, US adds another 5 Chinese entities to its entity list. June 26th, tentative truce deal reached days before G20 summit. June 29th, trade talks to restart and the ban on Huawei is relaxed. July 9th, US exempts 110 Chinese products from tariffs. July 16th, Trump threatens tariffs on US 325 billion of Chinese goods because they did not start purchasing agricultural products as they promised after leaving the G20 meeting in Osaka. August 1st, Trump says US will impose 10% tariffs on another 300 billion of Chinese goods starting September 1st. August 6, 2019, US declares China a currency manipulator after the yuan sunk to 7 against the dollar, its lowest level in 11 years. August 6, Chinese companies suspend new US agricultural product purchases. August 13th, US delays tariffs on certain products and removes items from the list. August 13th, US and China agreed to trade talks in 2 weeks. August 23rd, China announces 75 billion in tariffs on US goods as Trump threatens tariff increases on Chinese goods. All of these tariffs are again targeting agricultural products. August 26, 2019, Liu calls for calm. Trump says talks will proceed. September 1st, tariffs come in force as scheduled. U.S. began implementing tariffs on more than $125 billion worth of Chinese imports. Beijing, in turn, began imposing additional tariffs on some goods of 75 billion U.S., including oil. Currency devalues 0.5 during this period from May until October. September 2nd, 2019, China lodges WTO tariff case against the US. September 5th, China and US agreed to the 13th round of trade talks. September 11th, China unveils tariff exemption list for US imports. September 13th, China exempts various agricultural products from additional tariffs. September 19th, US-China mid-level trade talks in Washington. September 20th, US releases new tariff exemption, giving exemption to over 400 Chinese goods from tariffs. October 11th, US announces Phase 1 deal, delays tariff increase for Chinese goods. China begins purchasing agricultural products. And this is the big $50 billion a year of agricultural products that China supposedly had promised Trump after this famous press meeting. US tariff exclusion process for $300 billion in Chinese imports. November 1st, US-China negotiators talk over the phone, agree on trade points in principle. November 1st, China wins WTO case. November 7th through 8th, US and China talk tariff rollbacks. This is where we're at now, going back and forth to nowhere land. So during this period of easing, we saw a strengthening of 0.25. What happens next? Here's the basic idea of how we profit from this trade. We want to sell CNH at today's rate, which is approximately 7 CNH for $1 US, and buy CNH at a future rate, expecting to get more than 7 CNH for $1. One future contract represents 100,000 US dollars and only requires $2,000 a margin. So if we can buy $100,000 of CNH in the future, for example, potentially 7.1 CNH per dollar, we obtain 710,000 CNH in the future. And if we can sell those at today's exchange rate, which is 0.14286 USD per CNH, that would result in 101,428 US dollars, or a profit of $1,428 per option contract. Now, to flip the example, if we can buy $100,000 of CNH in the future, and then we have to pay 6.9 CNH against the dollar, we will only obtain 690,000 CNH. So you do the same formula, and in this case, you'll end up with a $1,428 loss. So that's if it strengthens and we've sold it short. If we can buy 100,000 CNH in the future for potentially 8 CNH per dollar, we obtain 800,000 CNH for $100,000 in the future, and we can sell it at today's price, 0.14286. That's 100,000, $14,288, or a profit of $14,288. So if CNH devalues from 7 to 8, we have a potential profit of $14,288 per contract. If we get a larger devaluation, perhaps over a longer period of time, the profits are remarkable. If CNH were to devalue from 7 to 12, we'd be able to obtain 1.2 million CNH in the future and sell it at today's rate. That's a $71,432 profit per option futures contract. Now, I am recommending at a minimum $6,000 of capital per future contract at Interactive Brokers. That will give you a cushion of around 0.36 for CNH to move against us before we'd start being worried about getting automatically liquidated. Let me show you the math on that. So assuming we want to have a 20% room of cushion to react and potentially add more capital to the position, we'd need to see a $4,800 loss. So for that to happen at this current point in time, CNH would have to go from 7 to 6.664. And so here's your math on that. Now that would not get a margin call. You wouldn't be liquidated until you got to zero. But this is why we want to have $6,000 of capital minimum per contract. And now we've seen, even during periods of strengthening, most of these have been less than 0.35, which is what we're calculating against right here. The biggest strengthening we saw was way earlier in the trade talks, at the very beginning when they had the almost year truce, when it strengthened by 0.7. Now the strategy is going to be slowly opening up 13-month future contracts for the lowest tax rate and to capture typical long-term moves in CNH against the dollar. The risk is a rollback of tariffs could strengthen the CNH in the short term. Risk management timing could result in losses. If you to jump in the trade 100% today and tariffs are rolled back tomorrow, you might miss out on this opportunity and result in a loss. So timing is critical. If a phase one deal is real, we want to enter the trade after CNH strengthens considerably. The fundamentals against CNH are not going to change, and their goal of becoming a world reserve currency is important. That's how they will get access to capital and become a dominant country. So if it were to strengthen all the way to 6, that would be a blessing. If the phase one deal fails, we want to enter into the trade as soon as possible with a full position. And if a phase one deal is up in the air, like it has been, and may continue to be for the foreseeable future, we want to slowly build into this position. The method is to use interactive brokers to sell CNH against the USD in the Hong Kong exchange futures market. Most broker-dealers do not have this exchange or this pair. It's considered exotic. Interactive Brokers does. Now, futures traders benefit from a more favorable tax treatment. So if we do believe we have a large profit that we would like to realize, we can still have a relatively lower tax rate. 60% of the profit can be taxed at the long-term capital gains rate and 40% at the short-term capital gains rate. So we'll pay a little extra premium for the 13-month futures contract, but if we can hold for the entire year, we can enjoy the lower tax rate on the entire gain. Here's how we get access to this trade at Interactive Brokers. Once you've logged in and created your account, you click on that little menu button, go to Account Settings. You're going to apply for futures, and specifically for the Hong Kong exchange. Once you are approved, in the trade box, you'll type in CNH. The drop-down box will appear. Click on the futures button, and keep in mind, I will be emailing you this written instructions in printed form so that you can easily follow it. Once that pops up, you're going to trade the trading date. Now, I'm not issuing a trade alert right now. Friday is when we will give specific trade alerts in terms of position size relative to total portfolio. The best trading date. After you've picked your trading date, click on the CNH button below, and that'll bring up a new screen with charts and such. We don't need to worry about that. And if you don't want to pay for the data, don't worry about it. You can, but if you don't need to, click the trade button. We're going to flip from the buy order to the sell order. And if you're used to trading Forex, it's going to be the opposite of what you're used to most likely, but we want to sell CNH. This is a illiquid product. And because we're going to be buying and holding, that's not a big deal for us. if you look at how I filled out this example, the red price will be the more expensive price and most likely to get filled quicker. We're looking for a big devaluation in the currency. So if you want to play around with a limit price that's slightly less expensive, you can do that and use a limit order that's good till canceled to get your position filled. Now, again, I will give clear instructions as to the position size relative to your total portfolio when the time comes. So watch our exclusive weekly Friday Bootcamp trade alerts for the buy and sell signals and position size per trade for this trade. In the next module, we'll look at an almost risk-free trade setup to short the Hong Kong dollar through the Forex market for potentially even bigger money with a better risk to reward ratio. So these two trades are very correlated, and the real estate bubble in Hong Kong is actually worse than that of China because the Chinese have been trying to get their money out of China and buy up everything they can, and a lot of it has ended up in Hong Kong. All right, guys, let's check out the questions out there. Donald, Karen, Oscar, how's it going?
How you doing, Jason?
Doing good.
Jason, doing good on this end.
Yeah, let's see what the best chart here. Let's go back to the big picture of their currency here. Here's their, so yeah, any questions first before I review any of the content?
Yes, I do actually. And I'm trying to remember exactly what it was. I was trying to write some notes down. When you were talking about the real estate bubble, which I've known about. I mean, a lot of most of what you've discussed, I'm very clear on. But I was trying to understand one component. Let me try and think here. It was about. Okay, I understand that they're not letting anything sell unless it sells at a profit. I know that they've got these ghost cities. They've had this for some time. But I think what was confusing to me is you were saying that some of the Chinese are buying additional properties there. Why? I mean, if they know.
Oh, sure, yeah. So let's look at that.
I thought I heard you say that. And I said, no.
So they're not allowed to. So there's very little they can invest in, and it's almost part of their culture is that to be a man who's worth being getting married.
Okay.
Not only should you own one house, now it's their culture is pushing them to own more than one house. So you can go get easy credit as long as you're willing to go buy a home. And so,
you said everything right there when you said it was their culture. I having dealt with multiple cultures, that's all. I get it.
And they're not allowed to invest in almost anything else. So yeah, you can see to keep the bubble going, people have had to buy 2 and 3 homes now.
It's awful.
Yeah, it's absolutely, it's madness. It's complete madness.
Gosh.
And here's the big picture. So yeah, imagine you just go and print $210 trillion of currency, keep it stuck in your country, and then you slowly sell tiny amounts of it to pay for what you need, and claim it's worth $1 for every 7. There's no free market, so they can't spend very much of their currency. That's the downside. The positive side for them is it makes their GDP look huge. But the second they open this up to free market, what about you, Oscar? Any questions or comments?
No. I mean, I understand the trade. I'm generally someone who likes to short stuff because it come back and bite you in the butt. But this seems pretty unlikely to go much against you.
Yeah, yeah. So certainly, so that's the good part of the trade. That's the risk inherent in the trade, is that they can, to a degree, manipulate it in the short term because it's so little liquidity and because of all the capital controls. So from that point of view, it's risky on our end because they certainly can manipulate it, at least for short periods of time. But that's counterproductive to their end game. Their end game is they want to open up their economy and become a reserve currency like the United States. And so there's all this talk about China trying to overtake the dollar. I don't think that's what they want to do. They just want to, they're trying to become like America in terms of a stable place to invest and store wealth. And to do that, they're going to have to allow the market to find fair value for all of these assets they have. And right now, there's been no price discovery. So that's why their public debt levels are so low. No one wants to buy their debt. Let me find that chart. And this is what's really remarkable. Imagine you've done these same trades on every single major currency out there over the last decade. Or the Argentina. Oh my gosh. Yeah, that really shows you they haven't grown their reserve currency whatsoever, but they've printed trillions and claimed it's worth all this money. But the market just doesn't buy it. They just are selling it as fast as they can in every way they can. And yeah, so let's look at these debt to GDPs. So yeah, it's interesting that China has such a low public debt, but that's because no one wants to lend the money. There's no government, there's no rule of law, there's no accounting, there's no auditing, there's no fair value. So one of the few assets you could play is the emerging market ETF through Hong Kong. But yeah, it's nobody wants CNH. They've printed 210 trillion units. So the renminbi is the currency, but the yuan is the unit per renminbi. And yeah, if they want to increase their line of credit and be able to actually spend all those CNH on commodities so they can build the Belt and Road Initiative, they're going to have to devalue. It's just as simple as that. No one wants to buy their currency and exchange it because they know they can never get it out. So they have a tough 10 years ahead of them where they try to get more credit without losing control of their GDP, without losing control of the value of their currency. So what's a realistic move? Well, just in the last year, we've witnessed they've lost 1 yuan to the dollar. But in the last few decades, they've lost as many as 7. So this can be highly profitable for us. So let's talk about timing and position size a little bit. Let me get back to the trade example. So we've seen some pretty big moves just from trade war talk. That's the short-term catalyst that can kind of get things rolling a little faster. The big picture is they really want to become a reserve currency. To become a reserve currency, they're going to have to open up capital flows in both directions. And to do that, they're going to have to let a whole lot of money out that's trying to escape. And so that is the big picture here. I think if we fail to create a trade deal by December 15th, there's a very good catalyst that could get this on the right side of the trade for us immediately. In fact, today, apparently, CNH is already bidding up in anticipation of this trade deal failing. Did everybody understand the math on these contracts, the risk, reward, all that, how that works?
Jason, this is Don.
Hey, Don.
And I do not understand that. Can you go back through that one more time?
Yeah, sure. Let's go back. Okay, so a futures contract is primarily used not by people like us trying to speculate. It's primarily big companies who trade in foreign markets, and they're trying to protect their sales that they have booked into the future against a change of conversion rate of their currencies or exchange rate. And so it's not like you're buying a stock, a bond, or an option like that. You're just getting a counterparty to take the other side of the trade. So if we sell CNH today in the futures market, we may have to pay some kind of small premium depending on how far out in the future we want to go. So for example, in this example right here, well, we'll get to the spread in a second. So we want to sell CNH at today's rate. Right now, we can get 7 CNH for $1 US. So if we enter into that futures contract today, it's kind of like doing the trade back. How do you sell CNH you don't own, right? So we're going to do the trade essentially backwards as far as how you'd logically think about this when we sell CNH against a dollar. So we're agreeing with someone who takes the other side of the trade to accept 7 CNH for $1 US. Okay? And our hope is that in the future, we can buy more than 7 CNH for $1. So we're hoping the value of their currency loses value in the future. So we can buy it for cheap and have already sold it at today's rate, which is more expensive. So one future contract represents 100,000 USD. And to open that contract, you just have to have money in your account. There's no, you're not buying a stock or an option or anything of that nature. So if we can buy $100,000 of CNH in the future for potentially a conversion rate of 7.1, so it's only devalued 0.1 Yuan in this example. Well, we'll be able to pick up 710,000 CNH. So do you see the math on that? 100,000 times 7.1, I get 710,000 CNH.
Yeah, I understand that.
Okay. So now I had to have paid attention to what my exchange rate was today because I'm selling it at today's cost. Well, at today's cost, I can sell 7 at a rate of 1. So right now, the value of 1 Yuan is 14 cents, 14.286 cents. Does that make sense?
Yes.
So if I can get 0.14286 times 710,000 CNH, that's going to be a value of $101,428. So I started off with $100,000. I end up with $101,428. So a profit of $1,428 in this example. So let's just go back. So I'm going to enter the futures contract and agree to the current exchange rate as far as what I'm going to sell my CNH for. And right now I get 7 CNH per dollar.
Good.
Okay. In the future, I'm going to actually purchase it. And I'm hoping it gets cheaper. So I'm hoping it goes up. So in this example, we get 7.1 per dollar instead of 7. So when I actually convert that, 100,000 times 7.1 is 710,000 CNH. Now I'm buying those 710,000 for $100,000. And when I close the trade out, I get to sell them for the exchange rate in the past. So the exchange rate we entered the trade in this example was 7 CNH for 1. So you just take 1 and divide by 7, and that's your cost in US dollars per CNH. So about 14.286 cents right now. So I can just multiply 710,000 times the value of each Yuan to get the gross sale of the contract. So I put up 100,000 capital. Not really. The broker's really doing that. They're only forcing you to put 2,000 down. And so if it were to devalue 10.10 Yuan, we would generate a $1,428 profit. Does that make sense?
Yeah, that makes sense. Now, I think we're all cognizant of the fact that they can manipulate their currency any way they want to. What you're saying is only for a short time because of the outside pressures of the rest of the world. Is that correct?
So yeah, they can, but it costs them money. So the way they can manipulate the exchange rate is to convert, is basically for them to give up their reserve. So China has, they had like a $4 trillion reserve. In the last year, they've blown through $1 trillion. So they've lost 25% of their reserve. So the only way they can actually manipulate the value of CNH, the offshore Yuan, is by giving up their precious currency that they want, which is anything except their own. So in an ideal world, let me go to that chart for you guys. This is the big problem they've created for themselves. So you can see in 2014, they had the biggest reserve, about $4 trillion. That's been going down steadily. And that's because their strategy of building these cities didn't pay off. They were hoping, they were hoping all these cities would be vibrant, fully utilized, making rent, generating profits. They did not hope for debt to grow to 300% of GDP. That's why they had to abandon these projects. They realized it was losing money. And so they've tried to print just more money than anyone's ever seen in history. And so the only way they can strengthen their currency artificially is to let people convert their CNH into dollars. So if they sit there and aggressively buy their own currency using their foreign reserves, they can do that. But what's the catch? They import $500 billion worth of goods a year, and nobody wants to be paid in Chinese currency because it's worthless. You can't exchange it. So what does the Chinese have to do? Well, first of all, they need to get dollars somehow. That's the only currency people do exchanges primarily in the dollar or the euro. So they have to get their hands on dollars and euros in order to buy all the stuff to run their economy, all of their imports. So luckily, they have this deficit with the United States where they're picking up about $500 billion of U.S. Goods that are being paid for in dollars. So they can turn around and use that to buy all the things they need to import into their economy. But now we're applying pressure to that. We're giving them less dollars. And now they're having a hard time buying all the goods to build just everything they need to run a 1.4 billion population. Not to mention they want to keep building stuff. So they have to import cement, all kinds of commodities. So they can strengthen their currency, but it costs them their reserves. And they've blown through 25% of their reserves. So it's a tough call. Do we try to maintain this Yuan that's valued at 6 to 7 at the cost of losing our reserves? I don't think so, because then they can't get any commodities. So they're desperate to get people to trust their currency. But in order to do that, they're going to have to stop restricting capital flows in both directions. So they're just in a very tough predicament. And Let me go to their GDP. And so you can see this madness, this absolute madness of building city after city. They got 50 million houses that are just crumbling. So they have a lot of bad investments, and it didn't work.
How come people are not utilizing that real estate over there? I mean, is there a particular reason they don't have the money, or what is the reason the people are not utilizing?
Yeah, I forgot to put one picture in here. They have 30 million Chinese living in caves in little. They probably have great life. They've done a great documentary. A lot of these people living in caves have better quality life than all of us living in our, heated homes. But so it's been sold. This has been pitched as the investment of a Chinese man to become married, is that he needs to support his country and purchase homes. And so you can see in this chart, not only do they own one home, now they're purchasing 2 and 3 homes. So the banks are happy to give out credit to anybody. Think about the 2008 bubble. Anybody and their mom could get hand on a loan and go buy a house that they could never pay for. And so they're not even finishing building these homes. The reason no one lives in them is because they're just concrete shells. And the reason no one's buying them is because there's no one who can afford them. China's been trying to leverage the good money, which is all the work they're doing for America, manufacturing. And they're trying to leverage that money and do some good with it. And their idea of causing good for their country was to try to put as many people to work as possible. And so what could they do? Well, they decided to build a shitload of buildings and houses until it was quite clear that they had created too much. And now we have city after city that's just been left abandoned. And so what's the plan now? Well, they have to get rid of a lot of bad investment. They need to get their debt levels down, and they need some more work, productive work that actually generates profits and revenues. And so, why doesn't America have cities that look like this? There's a good podcast about this. Why don't we have cities that look like this? Well, I don't know if you guys have ever seen the Hunger Games, where you got, a handful of tiny cities that the rich live in, and then everyone else is living out in the sticks with harsh conditions. That's kind of what it's like in China. It's very, very similar to that. So their hope now is that their Belt and Road Initiative will be a more productive use of capital. But the problem is that they're broke and their GDP is crashing and they have no access to capital. And now the U.S. is applying massive pressure in the form of tariffs. So they need to become having a world reserve currency is a huge benefit to your country. It essentially gives you massive line of credit to borrow from the world. And so the U.S. has taken advantage of that. Europe has taken advantage of that. Japan has taken advantage of that probably more than any country in history. But China can't, because no one wants their currency. So either they do it all on their own, which doesn't look too hot because their debt levels have gotten extreme, or they open up their country and allow the fair value of the currency to be found. And my big bet is that they have valued their currency way too strong and it's worth much less. And so slowly, as they let their GDP come down, they let these bad investments go bankrupt, they're going to be forced to open up the exchange rate of their currency, let it devalue. How do you get more people to buy your currency? Well, nobody wants to pay no one wants to buy 7 yuan for $1. Maybe they'd be willing to pay $1 for 14 yuan though. Maybe they need to pay $1 for 21 yuan. At some price, people are going to get happy about buying the Chinese currency. And this will allow them to fix this problem in this slide. What China needs to do is decrease the relationship of its foreign exchange against its internal currency so that they can continue to build and keep these people busy. So right now they're facing the problem of massive unemployment in China, which is their biggest fear. That's how they keep this huge population happy while they censor their internet. They tax them at a rate of 70%. There's pollution. People are scared to eat the food, rising prices and inflation. It's just, they've got a lot of problems. And it's because of this closed economy.
Hey, Jason, can we switch gears a little bit? Because I think you've made your case about, the reason why you're looking at this, but I'm trying to understand a little bit more about futures contracts.
Sure.
So if I'm understanding this, you're selling, right, a futures contract. So there's got to be somebody on the other side of the trade at a particular time. What I'm wondering is, with this being, I know out there in other markets, this is pretty common knowledge about what's going on over there. Who in the world's going to take the other side of this trade? And then do you close it? You see, I guess I don't understand futures, as much. And, you're selling it and then you can close it at some time. That means somebody else has got to buy it from you, just like an option.
Yeah, exactly. Yeah, exactly. So right now in this, it's a pretty exotic pair. And the rumors that HSBC Bank was the primary futures market taking the other side of the trade.
Uh-huh.
And they, so there's a lot of scandal. They just had to fire 10,000 people.
Yeah.
Now there's about $70 million in this trade currently.
Okay.
And it's primarily in the December month and the March month. So we're going to have to see if someone will take a longer bet. But this is important. So look at the premium. If we want to get 13 months of time, and this is actually more than 13 months. This is, 15 months. We're going to have to pay a little bit of an extra premium. So we're jumping into the trade, potentially already needing it to move about 10 basis points just to hit break even if we were to get that much time on our side.
Mm-hmm.
But yeah, absolutely. It's super low cost. I think it's $6 a side on the trade. And someone's taking the opposite bet.
Right. And then what happens in March 15th? So that's an expiration of the futures contract. What happens on that date regardless? I mean, is it just, it closes, it settles just like any other?
Yeah, so they will, exactly. So we'll buy the currency at that date and then sell it at the old price. So
Okay.
we're selling their currency at today's rate and we're buying their currency in the future rate.
Okay, but of course we can try to close out this trade earlier if it makes sense to do so.
And there's a nice tax benefit in the futures market that 60% of the profit can be taxed at the lower tax rate.
Right.
But this is but I do want to point out that, for China to really, they have a goal of trying to become a supremacy in Asia within the next 10 to 20 years. And there's just no way they can possibly achieve this while keeping their economy closed or their currency closed. So they're going to have to slowly but surely let all the hot air out of the economy and let this exchange rate of their currency, that's really their greatest value right now. You can't, they're probably not going to ever let you really own a Chinese company because it's all owned by the Communist Party. They might issue some bonds that could be of value. They're doing that right now. They're actually issuing about $5 billion in US denominated bonds because they need dollars. They desperately need dollars to buy all of their imports. No one wants to do business with them in their internal currency. And so as they gradually make this change, Probably their GDP numbers will look terrible, but more realistic. It's not like they're losing money if they clean up their act. But the benefit to them is if they can become a reserve currency, they will have tremendous access to capital, and they can convert the 210 trillion yuan into something they can actually use. Right now, they have 210 trillion yuan that are sitting around stuck in China, and they need to be buying things outside of China. And this is coming at a time where the U.S. is starting to restrict dollars into their economy through tariffs. So they need to make their currency attractive so they can convert CNH into foreign currencies and then use those foreign currencies to buy all the things they want, primarily commodities, energy, stuff to build, which is what they're good at. And so they're probably the best builders in the world, bar none. They can build things at a third of the cost of the United States and at probably twice the speed, if not faster. So they know they're very good at building stuff. The problem is they have too much production power and not enough demand for their production. So that's the whole hope with this Belt and Road, is that they can go create all this construction around their territory and create these increasing trade routes that will be profitable uses of resources, rather than building skyscrapers that are going to be empty. And so, if we can capture a move from 7 to 8, 7 to 9, 7 to 12, 7 to 14 over the next 5 to 10 years, it's tremendously profitable. We've seen even just a move from 7 to 7.2 can be profitable in the short term. But I'm more interested. I think there's certainly some catalyst to catch some quick profits if you're, of that mindset, just from playing the trade war escalation. And I may give some tips if I think that there's a risk of the trade war de-escalating after escalating, we might want to realize some profits and consider some shorter term contracts. But if they continue to tighten the currency, nobody's going to want to own CNH. No one believes that the real estate market's what they claim it's worth. So for them to get rid of the 210 trillion yuan, they have to make it more attractive to the world. To make it more attractive to the world, they're going to have to allow it to be freely exchanged. And so the bet is that that they're valuing it at a much higher rate than it's really worth, and they'll slowly have to allow the hot air out to achieve that. But yeah, imagine you had caught some of these moves in the 90s leading up to 2000. I mean, just sharp devaluations. And what's remarkable is that from 2010, you can see a high correlation. They lost control of it's either they lost control of the GDP or they just gave up. I think it's been about a decade that they've really dramatically slowed down building these skyscrapers. And so we're just seeing the effects now because they've stopped all these projects, that their GDP is falling very fast. And now they're losing, they're not willing to maintain the exchange rate because it's too expensive. They've already lost $1 trillion in the last, 2 years. They've lost about $1 trillion of real money from their foreign exchange reserve, trying to battle a slowing GDP and a trade war. So they could defend their currency, but they're gonna run out of money. And so when we look at this picture in Hong Kong, it's even worse. Now Hong Kong's exchange rate, you can't even play in the futures market, at least from Ameritrade or Schwab. But with the Hong Kong setup, it's beautiful because there's almost no risk they will try to strengthen it. It hasn't budged for 5 years, but the pressure mounting on the Hong Kong, that's another cost to China that they may not be willing to pay for in the near future, especially if all this pressure on Hong Kong continues. So their debt to GDP is the worst in the world by far, and as well as their housing bubble. And the problem is that China's grown much faster than than Hong Kong. And Hong Kong, instead of being a freely traded currency, it's trying to be a peg to the dollar. And so that's costing them a fortune, as money is allowed to be freely traded in and out of Hong Kong. And it's quickly costing Chinese too much. So that's a trade we'll do in the Forex market, where we put on the trade and just sit back. There's no cost, there's no expiration date. We can just sit there and hope one day they give up on controlling that peg and it breaks significantly higher. And Kyle Bass, Rogers, they're all thinking at some point China is going to come in and just try to buy out every Hong Kong dollar there is and dissolve it because it's costing them too much money, and then move the exchange to Shanghai as Hong Kong's becoming more and more problematic. Now that's down the road. Right now, Hong Kong's their only access to capital. They just raised some $20 billion for Alibaba in the Hong Kong exchange. So they're still trying to keep that peg right now. But yeah, if we can catch a 5, 10, 15-year move as they try to become a world reserve currency, the most likely outcome is they're going to have to severely devalue their currency to make it attractive, and let all these prices find real valuations. Otherwise, they're going to be stuck isolated with no access to capital from foreign markets. Let me show you guys where we can look at the open interest on these products. And I'm finishing up the email, so you'll have the step-by-step to click through once you get your account set up here. But you can see it's quite easy. Oops. Oh, I got the link saved one second. Oh, there it is. Finally, sorry. So, okay, so this is just the trading volume today. So the most popular trade is to do the front month And you do have a lot, in this currency at least, you have a lot of just very speculative traders like us that are trying to hit big profits with small investors, kind of like your call option buyer that I always tease about. And there's not a big spread. There's not a lot of cost. So if we wanted to sit there and roll over the position every month and manage it, we could. But one, really the moves are happening over a long period of time. So it's really extra work. And then two, we can get a much more favorable tax rate if we are able to hold it for a full 12 months. So I really prefer picking a 13-month contract and then slowly building into that position. That's if we have the trade war. So this is not showing us the absolute open interest. I'll figure out how to see that. But I've seen around $50 million a day of volume flowing into these contracts. So I'll look up what the exact open interest is. But just because we buy the 13-month contract doesn't mean we can't exit the position early.
Who's primarily playing in this particular market? Do you have any idea?
Sure. So anybody who's trading with China, it will be protecting any large orders against appreciation or depreciation. So big corporations are the primary users. Multinational corporations are the primary users of future contracts.
Gotcha.
And they're using it just to protect the sale value of orders that they have filled now that they'll deliver in the future. So they'll use that to protect their profit on it. And then from there, you get a much smaller group of people who are willing to speculate. And that would be, folks like us or Kyle Bass, investors.
Okay.
You got Donald. You want me to review the math on it one more time, just so you see how the numbers work out?
No, I think I understand it now. Basically, though, we're not going to hedge this bet. We're just going to shoot craps, right?
So let's talk about how we hedge this. Let me ask you guys this. If the Chinese currency were to strengthen dramatically, which market do you think would move? That's not a currency market. Do you think, which direction do you think stocks would head if CNH were to strengthen?
Yeah, the FXI would go up.
Yeah, emerging markets would go up and the SPY would go up.
Yeah. Our current EEM would go up dramatically.
Exactly. Yeah. So exactly.
So that's going to be our hedge then.
Yeah, exactly. But the big picture is, even when there's great news, recently it's only strengthened 0.3. If we go back 2 years when we had like a year of truce, it's strengthened 0.7. So if we're smart and we build into the position over the next, say, 6 to 12 months, we're going to reduce any large move of strengthening in terms of risk dramatically. So most likely what I'll be telling you is for every 300 shares of the SPY you own, that you'll enter one future contract at a time. So potentially, we got, if let's say the trade war just stays up in the air, they don't escalate or de-escalate, okay? Which very well could be what happened. Maybe not. Maybe Trump's going to lose his temper next week. If he loses his temper, we're going to rush into the trade and as fast as possible. If he doesn't lose his temper and they start to create a trade deal, we need to wait. We want to wait for it to strengthen. I would love to enter this trade around anything below 6.6, honestly. I highly doubt it'll go much below 6.6, even if we have, roses and puppy dogs, flowers and puppy dogs, Santa Claus world. Because we understand China needs to convert 210 trillion yuan into other currencies. That's it. trying to strengthen the currency is the exact opposite of what they really want to do. They want to get rid of that because nobody wants it, and they want to buy up commodities for their building projects. So if trade war is on, we'll rush into the trade. Trade war is going to ease. We'll just be patient, let it strengthen, and then perfect timing to jump in. And if it's just up in the air, we'll just slowly build into the position. So the maximum risk I would want to see us having in this position would probably be one future contract per 100 shares of the SPY. So I'm assuming you have at least 300 shares of the SPY so that we can leg into this into 3 parts and spread it out most likely over a longer stretch of time. And that's if it stays up in the air. So I'm not sure if we'll pull the trigger on this next week. Starting to look less and less likely like we've got a trade deal. So good news is, you know, we can literally wait for a tweet to jump on this and not miss out on a lot of the gains. Because once the heat is put on, it does devalue for a considerable time as everybody tries to sell their CNH in every possible way and puts all this pressure on it. Now also we'll be doing something similar with Hong Kong. And now that trade is a lot less risky because, you know, they're probably thinking whether it's even worth trying to support the Hong Kong dollar and the Hong Kong exchange in the long run at all. Now, right now, they do want that because it's how they raise capital. But the potential for them to strengthen that currency, it's never happened in 5 years. It's only budged 5 cents. So that's like a risk-free, boring trade we can put on and just sit back. And so not next week, but the week after, I'll be doing the whole Hong Kong presentation, which is primarily based on a lot of content Kyle Bass has done in interviews with Bloomberg, Real Vision. But I'm going to grab a lot more content from a lot more experts, a lot more data and charts so you can just see what a predicament Hong Kong is in. But that trade, and we'll also go back in history and look at other currencies. Anytime a currency tries to have a hard peg against another country, it's not really reflecting. Like right now, Hong Kong is in this weird world where it's directly attached to China, but it's trying to mimic the value of the dollar. So it doesn't make sense. And any time a country has tried to do this in history, eventually the peg has broke. And if it breaks, the potential profit on that is enormous, whereas the downside risk is almost none. So I like that trade. It's just, you know, maybe a very patient trade we sit on for a considerable amount of time. But the cost is about $6 to put on and off that trade, and we can do that from Ameritrade. The Forex market's kind of funny. It's a lot of little markets that are all kind of interconnected, but you don't want to go doing Forex at some random broker dealer. So I like using Schwab, Interactive Brokers, or Ameritrade for the Forex market, and they do cover the Hong Kong dollar. Now the order there is to buy the USD against the Hong Kong. So it's the opposite terminology from the futures market to the Forex market in terms of how the pairs line up. And yeah, exactly. Our long position in the stock market hedges us against these downside risks. And they're limited downside risk because, again, for them to strengthen their currency, it's going to eat away at their precious reserve, which has already lost $1 trillion. And that's a dangerous, you know, as that gets closer and closer to zero, that's going to become more and more dangerous for China because they can't buy all the goods that they need. They're the biggest importer in the world. And funny enough, they import the exact amount as the as we're paying them. So in terms of the trade imbalance, so they're collecting about $500 billion US a year, and net, and then they're spending that $500 billion to import commodities at 100-year low prices. And what do? They, you know, they're building stuff everywhere to try to keep all these people busy. So they'll want to continue to do that, and they need to make that currency more attractive to investors. So it's a problem that's not going away, and will just get worse and worse by the year, unless they make the currency more attractive, and then they can have access to outside capital. Valuations of their economy will go down, but they'll have real money they can spend to get these guys back to work.
When they started to notice this problem a couple years ago, isn't this one of the reasons why they also were increasing their gold in China?
Mm-hmm. Yeah, gold. They're trying to buy anything they would like anything except CNH.
Right.
Anything. So this is actually what I think we could actually realistically get in the next 12 months is a move from 7 to 8 with tariffs going up. And potentially a move of that magnitude, probably every year for at least 5 to 10 years. Now realize from 7 to 8 is a much bigger move than 8 to 9, and that's a bigger move than 9 to 10. So the profit margin from 7 to 8 is bigger than from 8 to 9 and 9 to 10 to 11. So yeah, can you imagine going from 2 to 4? That'd be equivalent of going from 7 to 14. In that example, just 7 to 12 is a 71,000. If they really lost control of that currency, and this would cause so much hell around the world if they devalued that quickly, because now all the other currencies will devalue. Can you imagine how strong the dollar gets? So they're just in a tough position. They're desperate for dollars, and they're getting cut off of dollars right now. So it puts tremendous pressure on their currency. But yeah, if we can get it to devalue even to 8 in the next year, very healthy profit, very good risk-reward ratio, and the big picture is really on our side here. Timing is important, so we want to be careful about not blowing our load in one trade, and paying attention to the tariffs, which are hard to predict because one day it's on, one day it's off, next day it's up in the air. But we got the election coming up. We got some pressure points. We have potential for Fed rate cuts in December and February. So Trump knows that, and if he does want to continue this strategy, essentially his strategy is shake up China, which shakes up all the emerging markets. It causes their currencies to devalue, and money's flooding to the U.S. So they're likely to continue that strategy until they get what they want. And everybody thought the tariffs and all this would inflation and ruin the economy and all that, and now we're just in a situation where all the money is flooding to the United States because of those actions. All right, guys. Well, any last questions?
You got mine covered.
Okay, great. Well, again, I'll provide specific strategies for when to buy and sell and the position size relative to how many shares of the SPY you have. So I'm going to assume most of you guys are going to have at least 300 shares so that we can leg into it in 3 parts, spread out, and that will help us greatly reduce surprises on the trade war front. So, if the trade war is escalating, I'll be more inclined to speed up the delivery of building the position. If the trade war does create the phase 1, this trade is not off if we get a phase 1. All that means is we're going to probably head towards 6.5, maybe 6 at the best, and then enter the trade. And so it'll be even more lucrative. So we'll see. Your guess is as good as mine if we get a trade deal. I'm inclined to say we don't, but we got to wait till we get an outcome. Probably most likely outcome is we stay up in the air for a long time. Oscar, any last comments or questions?
No, very appreciative of the information, Jason. Thank you.
Excellent. Karen, any last questions?
No, I just agree with you, and I've been kind of saying for a few years that the whole trade war issue. The Chinese are very patient. They have a long objective, and we don't do that here in the United States. So I think that's definitely something to consider. So I appreciate your input on all of this. This is interesting.
Great. Well, we'll get the replay out. Donald, any last questions?
No, you got me. Thank you.
All right, guys. Well, hey, another great module. Thanks for joining us live. I'll get the replay out this afternoon, as well as just the kind of the screenshots of how to fill out the order and get approved for the futures contracts. And it is the Hong Kong exchange is the futures market we need access to.
And interactive is the one that you feel is the best to use.
Yeah, so unfortunately, Ameritrade, Thinkorswim, or rather, I guess that's the same outfit, Schwab, they don't offer the Hong Kong products. The Forex market will trade against the dollar over at those. So you already got money sitting there. Might as well use that Forex product, that Forex market to do those trades, because you could even use some of the margin. You can use some of the margin from your stocks to put up that Forex position against the Hong Kong dollar. But as far as having to get cash out of your brokerage, we'll use that exclusively for doing this trade. And so the room of error that I'm recommending is around $6,000 per contract. And so Interactive Brokers is a huge broker dealer. They have extremely low rates. They're very popular with your 50 million to $1 billion hedge fund, because they have incredible selection of products. You can trade just about anything under the sun in any market through Interactive Brokers. So if we ever have some other exotic trade, it'll be nice to be set up and established at Interactive Brokers.
Okay.
For our exotic trading, which is what this is. Even though China is the second biggest GDP in the world, their currency is a joke. It's highly illiquid and undesired. All right, guys. Well, I appreciate it. And until next time, I guess we'll see you guys tomorrow, okay?
Thank you, sir.
Thanks,
Thank you
Jason.
so much. Appreciate it. Take care.
Thanks.
All right. Bye-bye.